As I have been telling you, I'm coming to you from the Citibank India headquarters, and we've been speaking to the creme de la creme of Citi's researchers and economists. I have with me Saurabh Handa, who is the oil and gas analyst at Citi India. Saurabh, thank you very much for joining us. Whatever the issues, demonetisation, Trump, would your space, oil and gas, be an island of relative performance? You all are bullish on it?
Yes, so we are quite positive. If you look at the demonetization impact, the first order impact actually should be fairly limited. In fact, fuel is not really a discretionary product. So fuel demand actually saw a bit of a spike post demonetization.
Yeah, they were giving cash, that's why.
Absolutely. So that's not obviously recurring. It will normalize. I think it should have normalized already by now. But the key is that on the businesses, there should be not so much impact, at least in the near term, because fuel demand should remain quite okay. Obviously, the second order impact, if we start seeing a broader economic slowdown and say over an extended period of time, there is an impact on, say, vehicle demand, etc., then that could have an impact. But near term, it looks quite unlikely. So businesses stay okay. As far as stocks are concerned, that's also been fairly comfortable because valuations there are quite reasonable. So compared to other sectors and stocks which have seen a bit of a derating, given valuations in the sector are already quite benign, the downside should be fairly limited, and we've already seen in the last 2 weeks that they have outperformed. So we remain quite positive. In fact, our strategist has raised his overweight on the sector recently.
Okay. Well, I'll leave the more involved questions on energy to Sonia and Anuj, but I'm actually more interested in the gas sector. Lately, in the past year, it's gas stocks that are more interesting than the oil stocks, which are more predictable in their move. How are you looking at this sector? Are you going to see, are you overweight on the Petronets and the Gales and the GSPLs? Is there a lot of business coming? How should we understand that sector?
Sure. So we have been structurally positive. We became positive over a year back on the gas space. So there are 3 or 4 key emerging themes which we are seeing, which will play out and which we've already started seeing are playing out. One is gas consumption in India is picking up. Secondly, the global factors are very supportive because of a lot of LNG supply globally. LNG prices are coming down. Thirdly, the regulatory risks that we saw in the gas sector have now actually reversed, and there are a bit of regulatory tailwinds happening. And the last thing is there are also environmental concerns, as we are seeing in the case of Delhi, which is supportive for gas usage. And what we've seen from the government also is repeated statements that they want to increase India's overall gas consumption. So we like the space. We would be a little more selective. So the stocks that we like are the ones where we believe the risks are on the lower side and the visibility on volumes is better. So we like IGL, Petronet LNG, and GSPL. Where we are a little concerned is stocks which have taken the commodity risk, stocks like GAIL, where there is a bit of concern on some of their LNG contracts. And also because almost 60% of earnings come from the non-gas business, such as LPG, petrochemicals, and even trading, which is a little volatile. So we would advise investors to probably play these through Petronet, IGL, GSPL.
Fair point. Anuj?
Saurabh, hi, good morning. The last 2 years have belonged to the oil marketing companies. We've seen a Goldilocks scenario play out for all these downstream companies. Upstream companies, of course, saw 52-week lows before bouncing back. From here on, what's your preferred play? Upstream, downstream, or are you looking at them stock-wise?
So currently our preference is still downstream over upstream. That's been the case for the last year or so. And the reason why we would continue with that is because oil prices are still fairly benign globally. We are seeing positive demand impact of low oil prices. So fuel consumption has been very strong in India, which is benefiting the downstream marketing companies. Post decontrol of petrol and diesel, a key thing has been the government's role, which has been fairly non-interfering as far as setting of prices is concerned, which we view as quite positive. Refining outlook is fairly benign. In fact, we are quite sanguine on the refining outlook. So overall, I think it's a space which is still worth investing in. Also, fuels like LPG and kerosene, which in the past a lot of governments were not too keen on touching because they were considered fairly politically sensitive. This government is trying to make some, moves even on that front. So overall, I think OMCs still look quite decent. On upstream, we are still not over positive. We still prefer the downstream pack, even though we have a slightly constructive oil view. So Citi sees oil averaging around $60 next year. But even on that, we don't see too much upside for the upstream names. We think risk reward is not that favorable right now. The other thing is that upstream companies have a bit of asymmetric leverage to oil prices. So on the downside, they get hit. But on the upside, the subsidy uncertainty comes in. So we would still prefer to play the OMCs over the upstream pack.
Okay, so within the OMCs, Saurabh, BPCL has been the big performer. It's up 50% this year, and it has the, Kochi refinery capacity expansion that will come on stream by the end of the fiscal as well. So that trigger is there. Do you think it will continue to outperform its peers?
Yes, that is our call. So BPCL is our top pick amongst the OMCs. There are 3 or 4 key factors there. One, you rightly pointed out, there is an organic earnings kicker coming in the form of the Kochi expansion, which is just around the corner. By 4Q of FY17, that should start contributing to earnings. Secondly, BPCL has seen its capex sort of peaking this year. Their capex intensity should start coming off over the next few years. For the peers, actually, capex will start going up because they are now getting into a lot of refining, expansion and modernization plans. So that helps from a free cash flow perspective. Thirdly, in a rising crude price environment, we believe BPCL becomes a bit of a better hedged play because it has E&P upstream exposure, particularly through Mozambique. And also, BPCL has been making some steps towards non-fuel retail, which is going to be a thing of the future for some of these companies, because as competitive intensity rises in a decontrolled environment, you have to look at other alternatives to stem your market share. So BPCL has sort of been the first off the blocks there, and which is one of the reasons also we continue to like it.
Okay. A final question to you, Saurabh. You all have some of the best experts globally on oil and gas, Ed Morse and Kleinman. Yeah. What is the sense you're getting on gas? Will we continue to have this cheap gas advantage even as other energy prices, crude for instance, has bottomed out? Will India continue to be able to benefit from that?
Yes, so in fact, I think what we've seen playing out on the oil side could actually play out on the gas side over the next few years. So what we've seen this year is that the gas oversupply or the LNG oversupply is actually yet to hit the market. So over 2017 to 2021, 22, Citi's house view is that there's going to be a huge LNG glut globally. So you have a lot of new projects coming up in Australia and the US, which are only now kicking in. That's happening against the backdrop of demand in big LNG importers such as Japan, Korea, etc., peaking out and not growing very sharply. So India is actually becoming one of the lone or the big drivers of LNG demand globally. So this actually is a pretty sweet spot that India is in. It could be for 4 or 5 years when this oversupply lasts. But what could happen in such a scenario is that the traditional linkage of LNG prices to oil might break down. Okay. So even in 2016, we've seen, say, spot LNG is traded at a 10 to 15% slope to oil. And that potentially could sort of come under risk if there is an excess LNG in the market, which also drives a positive view on the gas value chain and companies like, say, Petronet, GSPL, etc.
All right, that is a lot.